great future. We're talking real money.
Hello again. Welcome to Talking Real Money, the program designed to help you manage your money better. That's our goal. Always been our goal for as long as we've been doing this, which is a very long time. Our telephone number for your questions, your ideas, your thoughts, your opinions even, is 855-935-8255, 855-935-TALK. I'm Don McDonald here in the studio in Florida. Tom is still in the laundry room in
Laundry's
Duval.
Still got to be done. Things get dirty.
Somebody
you need to
has
wash
to
them.
do the damn
That's
laundry.
Right. In here with all the spare shoes I see and blankets.
I am impressed because I thought when you bought the place you were just going to be like washboard down by the lake. So it really does have a laundry room.
It does have a laundry room,
very
and actually
21st
now
century.
I'm back. You can quit making the jokes. I'm back to just one house now. So we got rid of the other one yesterday. Thank you. Goodbye.
Oh, this tells
so
you it's
nice.
time for Tom to buy another house.
No,
I only have one house. Oh my goodness!
I know.
No, it's nice. You have money now. You have some money in the bank again.
Yep. I know.
Money in the bank.
Trust me, it has not been fun emotionally. I hated it. I hated having that hanging out there. I really did. I wasn't very good at it. So.
But then when you have it in the bank, the question becomes, how do you make money on it while it's in the bank? Do you know what the national average 1-year CD rate is? Average.
Oh, I'll say 3.75.
You would be so wrong, sir.
Oh, 4.25.
The average is 1.75.
That's crazy.
That tells you that the reason that is that low is because of banks like Chase and Bank of America.
But who is buying a CD with that? That's
They're customers who
apparently know nothing. I know
they don't go shop. They don't go shop.
Because you go to bankrate.com, and I just looked it up today. You can still get a 1 year that's paying over 4%.
Yeah, but when you look at the banks that are paying it, you kind of go
FDIC insured banks.
I know, but you look there, you go VO Bank. I've never heard of VO Bank.
I know, and you don't get to go walk in
or
and
Next Bank. Marcus, that's part of Goldman Sachs. Yep. They're at 4.25. American Express down to 3.9, and they used to be up around 5. So
more troubling than that. Yeah,
we're seeing a general trend.
Yep,
toward lower rates,
and at the same time,
that freaks people out.
And then at the same time, fund assets in money market, et cetera, are going up. There's like $7 trillion.
Well, because that's supply.
Yeah, right.
That's a lot of supply of money. Or a big demand for higher rates, and so the banks are going, we don't have to pay as much. There's a lot of demand. We're getting plenty of money.
And if you believe the experts, Morningstar, Federal Reserve, et cetera, rates will be lower again by this time next year. They're saying maybe by a percentage point. Now, we don't know, right? Okay.
Right. We don't predict. Somebody else is predicting.
Yeah.
But here's what happens. Somebody else predicting causes you to worry.
Yeah, well, to make a dumb move. I mean,
that's what I mean. When you start to worry, you start to think, well, where will I go to get better returns?
Yeah, and guess what? They've got lots of great ideas for you.
Who are they, by the way?
This comes from an article at Morningstar. They say because rates are going down, nothing's going anywhere, by the way. Everything's gone. But because the rates are dropping, you should move to longer-term bonds, longer duration bonds. If we've ever heard this one before.
Let's stop on this one. And talk about what's wrong with that advice.
Well, they have to be. They're riskier than shorter term bonds.
Why are they riskier?
Because they're more subject to interest rate change, and you're holding on to them when rates change.
And let's make it easy to understand. You put $10,000 into a 1-year bond paying 5%. That bond, the yields on bonds drops down to 3%.
Yep.
Now, that 5% bond is going to go for more. You'll be able to sell it to somebody for more money.
Of course.
Because that 5% is worth more. But if rates go way up, to sell that bond, you're going to have to discount it. But not by much, because it's going to mature in a year, and you'll be able to reinvest in the new higher rates. If you have a long-term bond and rates go way up, that rate's going to be stuck for decades, possibly.
Yeah, let's talk about what happened in 2022 with that.
Because this has happened before. 855-935-TALK is our phone number. Let's talk about your money. We'll be right back.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
If you are trying to live a better life financially, we're one of the better resources, we think, for you. One of the best ones that you can access regularly. And on Saturdays, you can call us at 855-935-TALK and talk to us one-on-one, noon to 2 Pacific. For those of you listening to the podcast, that's 3 to 5 Eastern. 855-935-8255. Right now, we're talking about interest rates. They've slipped down a little bit. People are anticipating that they might go further. We don't know. But there is a problem. When you stretch for yield, and there's a lot of advice on ways you can make more money from your money, you can put yourself in jeopardy, particularly when you extend your maturities out to 10, 15, 20, 30 years on bonds.
Yeah, and I think you can learn that lesson very easily looking back just a couple of years ago, 2022. Those longer-term bonds really got hammered. All bonds lost money, went down in value, during that horrific year. But the ones that were 10 years, 15, 20, those lost a lot more money. That was one. Number two is quality. You mentioned duration, maturity. That's very important. But keeping your quality of a high, other people are now suggesting go buy more risky corporate debt issued by companies that dicey from time to time. Can they pay you back? Can they not pay you back? And they call them high yield bonds. There's another name.
That's junk. See, high yield is a euphemism.
I know.
It's designed to make them sound much more enticing because they're yielding a lot. Well, they're yielding a lot because they're junk.
Exactly. And then there's even more suggestions around going overseas to buy more debt, especially, and it wouldn't surprise you to know that Brazil's 5-year bond yield is 14.1. Which looks compelling against inflation rate of 4.8. Mexico, 5-year debt, 10.1. So we'll just go buy those, get paid a lot more. Now, there's a trade-off here that people have a tendency to forget. I'm just making more money, right? You are, until they can't pay you back. And then you're going to make a whole lot less money. I mean, this is the part of the equation people forget.
That's happened before.
Yes, it has. So, we really want to be careful. I mean, again, in the big picture, your bond portfolio should be the ballast. That should be the stuff that's holding its value depending on bad economic, while stocks are the thing moving up, hopefully, and sometimes down, up, down, a little more volatility there you're willing to accept because that safer part of your portfolio is sustaining its value for the long haul.
And let me try, and Michelle Singletary in the Washington Post said this does not have effect on people, but I don't believe her. She said when you tell people that that the higher the return, the more the risk, they don't hear that. Well, okay, then let's try it a different way. Let's talk about what the realistic return you can expect today in 2024 on various levels of risk. At the lowest possible level, where you're pretty much guaranteed you're going to get your money back by the government or government insurance, the best you can expect is in that 4% range. It's about the best.
Well, you just said the average is like 1.5 or something.
But that's the very best.
Oh, yeah.
So, and historically, over the past 100 years, at the opposite end of the spectrum, the best return you could expect, like on small cap stocks, is up around 10%. That's the range, approximately.
Historically.
So if anybody promises you something that say it's safe and it pays more than 4, you know the risk is higher than non-existent. If someone is saying got an investment with some risk, but it's going to return 20%, well, they're probably lying because the risk is not just a lot, it's probably astronomical.
Yeah, I was just listening to a podcast last night.
Just know what the reality is.
Yeah, where they offered the investor 9% a month. Oh,
A
you know,
month.
That's a month. That's something, that's kind of off the scale risk-wise.
Okay, really, that's just
Yeah.
a lie.
Well, it turned out
that's just a lie.
It got worse in two ways. It turned out the investment was for hard money, short-term, high-interest rate loan. And then the other part was the person supposedly making those loans was just stealing the money. So that makes it even harder on the return.
I was going to say the only ones who are probably getting 9% a month are mobsters.
And then that's the name of the show is Lady Mafia. You broke the code there. There you go. So.
It really was called that?
Exactly. Yeah. She ended up stealing it, and she has not yet been sentenced, but she will go away for a period of time.
Most of the time, I can't tell you how many times we've seen this after the fact. Of course, we can't tell you at the time that it's absolutely for sure a scam. But generally speaking, they've always eventually, these high returning deals have always turned out to be a scam.
Paul Merriman said about Alan Sanford way back when he was running those ads saying, look, he's like, how does he do that?
We used to talk about him on the show all the time. I'd pull my paper out and I go, how is he paying this?
Right. And it turned out, because you were taking Don's money and giving it to Tom. That's how he was paying it.
Yep. 855-935-TALK. Call us. We love talking with you. And Jody, you're next. Welcome to our program.
Oh, hello.
Hey, Jody.
Can you hear me?
Yes.
Hello, can you hear me? Oh, great.
I can.
Okay, my question is the future of the FDIC insurance, if it will change at all under the new administration coming in. Will it stay the same, or will it get put to a different department? And how is it funded? I mean, is it secure? That's my question.
Well, the banks all chip in something for the funding.
Yes, they all. It's an insurance policy that all of the banks pay into. It's the Federal Deposit Insurance Corporation. So they have enough money to take care of anything short of a Great Depression style run on the bank. However, they have a legal backstop. The legal backstop is, should they run out of money, the U.S. government will provide the funding necessary to bail out those banks up to the deposit limits, and eventually their plan is, and it's always worked so far, we don't know about the future, but it's worked so far, they get the money back from the sale of bank assets, or they raise the amount of money from the banks that survived. They raise their insurance premiums.
So you could say, in a way, it's backed by the full faith and credit of the United States of America. But the question to you, Jody, is why do you raise this issue? I guess I'm curious.
She said it. The current administration, the incoming administration.
The incoming, they want to shrink the federal government, and rumors, and I hate to say rumors, is they want to get rid of the FDIC or move it somewhere else. And I don't know how true that is.
There are a lot of things that I don't
know if I need to move my money.
No. There are a lot of things that the president-elect has said he wants to do, and there are lots of things president-elects say they want to do in the past. But they have this little problem. Well, they have these three little problems. One is the House, one is the Senate, and the other is the Supreme Court.
Which are all very narrowly controlled by a more conservative group, but narrowly.
And if they pulled FDIC insurance, there would be a panic. That's
like one of those things. It feels like when people say you're not going to get your Social Security check. Okay, but so many people are so dependent on that would be, pitchforks and torches at the Capitol. So
it would look like South Korea just looked, or only worse.
Right. Middle of the night, rushing in. I think that's one of those things you could probably take off your worry list.
Yeah, I agree.
Okay, thank you, because I'm, a little worried.
There are plenty of things to worry about.
Oh, yeah.
That is not one of them yet. We don't know.
Yet. Okay.
Yet.
Well, we can't say for sure, for guarantee, but been around for almost 100 years. You're probably
We can say, generally, we're confident.
Oh, don't say that. I'm not saying it
in general. Thanks so much for the call, Jody. We've got lines open, bunches of them, by the way. If you've just been thinking, I don't want to wait on hold. Well, if you call right this second to 855-935-TALK, you won't.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
We don't believe that anything is accurately and consistently predictable. We just don't. And so that's why we say the things we say. You can't know. And it's really interesting. When it comes to interest rates, there are all kinds of myths. And when it comes to bonds, too, there are all kinds of myths and misunderstandings. Interestingly, now, do you remember a few months ago, it was back in September, that the Fed cut their rates to other banks
Discount
by
rate,
0.5%, and then a couple months later they cut it by another 0.25%.
I think it's 0.25, correct? Yeah.
Yeah, and remember in the media, think about this for a minute. I heard it from friends, I heard it from realtors, I heard it in the news. Well, this means that mortgage rates are going down.
And what happened?
They went up.
Yeah.
They went up because short-term overnight rates do not correlate to 30-year rates. They are not. 30-year rates are a supply and demand rate. The Fed cannot and does not control those rates. That's what you and I are willing and able to pay, and what someone else is willing and able to lend it for. It's a supply and demand equation. Yeah. And there are a lot of other myths about bond investing, fixed income investing, that they're in an article in Barron's written by Alan Roth, who we really like.
We know Alan. Yeah.
And we're going to bust some of those myths.
Yeah. I mean, you want the first one?
Yeah. What is that first myth that Alan
And this
discusses?
is a fascinating one to me because I do hear it from time to time, and people say, well, I don't own bonds because I don't understand them. They're hard to they're difficult to explain. Are they?
Yeah. Have you ever borrowed money?
Yeah.
You created a bond when you borrowed money from someone. A piece of paper was signed where you said, I promise to pay you back X amount in a certain amount of time. It's also called a promissory note. It's also called a bond. That's the essence of a bond.
Yeah, it's a loan.
That's all they are.
It's far different than investing in stocks, or as they're sometimes called, equities, because there you own a piece of the company, small as that may be.
Right, with the
But that's a
bond,
whole
you don't
different
own
thing. Yep.
any asset of the company. All
Exactly.
you have is a promise to pay and certain stipulations should the person who borrowed your money not pay you back.
Yeah.
And that may be the ability to attach assets, but you don't own those assets unless they default on the loan. They just have to pay you back what they promised to pay you back in the time that they agreed to pay you.
Yeah, and I think people get confused because then interest rates change and they say, well, wait, the value of that bond changed. I thought it was a piece of paper that said, here's how much you're going to pay me back and here's when you're going to give me my principal back. Well, that all still is true, especially if you own individual bonds.
If you buy a bond that a company issued and it's for 10 years and it pays X amount, no matter what rates do, if you wait until that bond matures, you're going to get back, unless the company defaults,
Right.
You're going to get back the amount you put in plus the interest over that period of time.
And in some
however,
cases, you have
if you
to wait.
want to save it, if you want to sell it before that 10 years expires,
there you go. Yeah.
that's when the value of the bond will fluctuate, because you'll either be able to raise the price because your yield is higher than the current rate, or you'll have to lower the price to make up for the new lower rate that exists when you try to sell it.
That's the part that people get confused about.
Yeah.
But yes, those are equivalent, right? They're tied at the hip, they're joined at the hip, if you will. Because
Well, let me do it. Let me try it this way. Let me do it. There's just really three things. When you buy a bond, you can either hold it to maturity and get what you paid for it. Okay? Or if rates go up and you want to sell it early, the value of the bond will go down.
It has to.
If rates go down, the value of the bond goes up. So it is an inverse relationship between current rates and the value of a bond that extends out a number of years.
Okay. Well, when we come back, we'll talk about some other myths. How would that be? There's a lot of myths. Yeah. Some realities, some
Hits
myths.
or misses.
Yeah. So we'll talk more about those.
Yeah, we got a couple more for you, and we also have a couple of lines available for you at 855-935-TALK, 855-935-8255. It's easy, it's free, it's relatively
Free and
painless,
easy?
as long as Tom is feeling good about the day and isn't
Fumes
yelling
from
at
the
people.
tide. They're really getting to me.
No, I try to keep him from yelling at you, but sometimes it's difficult. We'll persevere. 855-935-TALK. It's free, remember.
Tom and Don are talking real money. Reality Radio radio for a really great future. We're talking real money.
We're talking about bonds right now because bonds should be a part of your portfolio.
What if you're 25 years old?
Maybe not then.
Yeah. Okay.
But 30, maybe. I don't know. You see, because it depends on the people. It's not age-based.
That's true.
But you need to understand how they work, or you're not going to want to use them because there are a lot of misconceptions. I mean, one is that they're incredibly complicated, and there are incredibly complicated bonds. But we're not talking about those. Convertible, preferred, whatever, it's preferred stock. Convertible bonds, there's all kinds of complexity. But one of the misconceptions, Tom, is that bond funds, that the funds themselves are higher risk than just buying individual bonds. This comes up a lot on the show.
And it came up a lot in 2022. A lot of people said, well, bond funds are going down, have gone down. Why would I just hold a bond individually and I would have done better? Now, remember, when you hold a bond fund, you get diversification, right? Because you don't hold just one bond. If you hold one bond, it's like holding one stock. Maybe they pay you back, maybe they don't. It does not often turn out well, right? Number two.
Well, I wouldn't say that. I would say it often turns out well. Strong. But occasionally it does not.
Thank you. That's fair. Number two, when you hold a bond fund, you get kind of a laddered approach, right? You get various maturities to a degree. I mean, we don't want you holding anything longer than around 10 years anyway, but you get a variety of bonds, types of bonds, and you get a ladder. So you kind of get it should help cushion the blow from chasing interest rates, right? Because different securities are issued at different times.
Right. And if you had a portfolio of individual bonds and you bought them all at the same time, and rates fell or rose, the value of all those bonds would change at exactly the same rate.
Correct.
Whereas if you had a portfolio of them, as rates, let's say they're rising, new bonds are going to be coming into the portfolio, raising your yield. If you own individual bonds, your yield is not going to change unless you buy new bonds.
And one thing Alan didn't mention is, in today's world, Vanguard has some and they're not the only ones, but they hold bond funds that are available at incredibly low prices. And you don't have to pay a commission to get them. If you
and
go
you're not
buy
paying the big spreads.
That's what I was saying. If you go buy individual bonds, people think, well, I get them for nothing. No, you don't. The people selling them to you have figured out a way that they profit as well. And I'd rather hold a bond fund where Vanguard does this and buys them much cheaper than I can go buy them one at a time. I can guarantee you. Can I say that? I can almost guarantee you.
No. You can't say that.
I can almost guarantee you.
Generally guarantee.
Generally, please, that they do a better job of it than
wait
you
a minute.
will.
Doesn't that weaken the word guarantee to the point where you shouldn't even use it?
I know. Well, okay. I can't guarantee
I try to never use it.
I think you're right. And I think because we can't guarantee anything.
Right.
But I can suggest that Vanguard does this better than I will do it.
Yeah.
How's that?
Now, let me just throw an alternative in, and that is for those who are disciplined, those who are well organized. And I don't know why I'm doing this because I'm neither of those, but you can do a ladder. You can do a ladder of CDs.
And you're doing CDs. Yeah,
I'm doing this. I have as a portion the part of my fixed income portfolio is in BND.
Yep.
Part of my fixed income is about half and half. Half of my fixed income portfolio is in a 5-year CD ladder that every year, when that 1-year CD matures, immediately I invest that in the highest yielding 5-year CD I can find.
Yeah, and I told somebody recently that I didn't do any of that on my own, and they were shocked. Like, what do you mean you don't manage your own money? I have no interest in that, frankly. I don't want to spend any time on it. There are people, by the way, that work with us that do it better. And I just don't want to I don't want to think about that. So I don't even worry about that part of it.
Well,
but here's another myth.
4 hours a night watching television. Oh, wait, that wasn't you. That was somebody else.
That wasn't me. Here's another myth that I find fascinating that it won't surprise you to hear this, that bond interest rates are predictable. That people know what's going to happen next. Boy, didn't we just live through a decade where they told us that rates had to go up?
Had to go up, yep.
Had to go up.
And the smartest people in the world were telling us that, supposedly.
Oh, yeah. The bond king, the
and
bond
remember,
prince.
As we mentioned earlier, even when you know that a rate, like the Fed funds rate, is going to go up or down, it doesn't impact longer-term rates.
And that's the part that's why we talked about that at the beginning. That's where the difficulty in explaining things happens.
855-935-TALK is our phone number, 855-935-8255. It's funny, Tom, during the bottom of the hour break, I want to talk about this when we get back. I found an article that tells you how much a Vision Pro can make you, save you.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
855-935-TALK is our phone number. I want to share this with you really quickly. I went to the Apple Store a while back and did a demo of the Apple Vision Pro, which is their virtual reality headset.
And frankly, haven't stopped talking about it since.
No, I haven't, because it's my wife's fault. She won't let me have it until Christmas, even though I paid for it. She won't let me have it till Christmas.
Okay, that's like 10 days. You can do it, man.
I don't often splurge on things.
No, you don't.
I have a very boring
In fact, you
car.
make fun of me for splurging on hotels and the like.
When I go to a hotel, for example, I'm going to Seattle for retirement. I'm staying at Courtyard.
Yeah,
you
are.
Okay. I don't stay at fancy stuff. I don't buy myself a lot of fancy stuff unless it's for work. I will spend money for work.
Or
and by the way,
any audio-related items.
No.
You could get by. Okay, how many microphones do you have now?
Okay, those are for work.
Ah, okay.
I don't do anything fun on them. I work.
Okay, yeah.
And the Vision Pro is going to be partly for work because it creates a very big screen for my Mac.
Wait, so I'm going to talk to you through the Vision Pro? You're going to see me in 3D? That's going to be scary.
Absolutely, I know. But anyway, I saw this article during the break at the bottom of the hour from a publication called Shortlist out of Great Britain. And the article's headline is, 5 Apple Vision Pro experiences that let you live a millionaire lifestyle. Now, the Apple Vision Pro costs a lot of money. It's $3,500.
Mm-hmm.
However, eventually there will be courtside tickets available for soccer matches and basketball games. And they even have an immersive experience where it's a courtside experience with the NBA All-Star Game. A ticket right behind the courtside seats, and these are courtside seats in 3D, is $70,000 for the All-Star Game. So right there, I would save $70,000 when that happens.
Which you would never do, but okay, fine.
There's an Alicia Keys private concert where literally she is performing in 3D right in front of your face.
Okay.
Privately.
I was going to have her for my birthday this year.
Alicia Keys recently turned down a $9 million offer for a 9-minute private concert.
I guess it's out then for my birthday.
So there's $9 million. Oh, I get 20 minutes with Alicia Keys, though, so I'm just going to say $9 million. Let's just say it's 9. Then
so now we're at $9,070,000. Okay.
Right. I can work at Joshua Tree on a volcano in Hawaii. It has these virtual experiences. Yeah. And this guy says a trip to Joshua Tree National Park would cost me at least $2,000 to go work a day there. So there we go, $2,000. A personal cinema.
$72,000.
Like a really nice basement personal man cave cinema.
Right. Mm-hmm.
Runs around $30,000 for the top of the line TVs and the furniture and all that stuff. There we go. I have that because, by the way, under Apple Vision Pro,
$9,102,000.
The screen is 100 feet wide.
It scares me that's going to be attached to your eyes that way.
I know.
But okay.
It doesn't scare me. And then finally, I can take a private tour of the Louvre on Apple Vision Pro in 3D high def, like 4K. Well, I could spend all the time I want staring at the Mona Lisa, and she can stare back at me and move her eyes with it.
Yeah.
A private tour of the Louvre costs about $30,000.
What? I'm going to get one of those next summer. I'm going there next summer.
I will have it on my face.
I'm not spending $30,000. Wow.
I will have it on my face for $30,000.
So now you're at $9,132,000.
Now suddenly it's an investment. Okay. And it pays off. $3,500 to $9+ million, $10 million.
I guess I'll have to try it with the soccer,
Oh, dude, the soccer thing is unbelievable.
Remember now, I've been on soccer fields with soccer players for 30 years, so 35, 40, whatever.
Yeah, but you can't sit where the ball is coming right in your face.
I'm going to redesign it so you get to be the referee in the middle. That's how I'd live it. So
That'd be
there you
fun. All right. 855-935-TALK is our phone number.
Merry Christmas,
Can
my
you
friend.
tell I can't wait till Christmas?
Yeah, pretty much.
This is the first
You were literally
Christmas-
like the kid with the...
I feel like it. This is like the first Christmas present since I was like 10, I think.
that you're that excited
That I was
about.
really excited about opening.
Okay. Fair enough. I'm
No
happy
one will
for
ever
you.
See
I'm really
me
happy.
again.
No
one will ever see me again. And then I can open up my MacBook Pro, and you punch a button in the air, right in the air, and this screen that is the size of two 5K screens pops up in front of you, and I can work on this giant screen.
I don't know that I'd like. I feel like a headache if I had that.
Well, you
but
don't
okay.
edit audio and video. I do.
No, I do not.
And that would be fun on there. Anyway, let's go to Everett, Washington, shall we? Mark, welcome to Talking Real Money.
Oh, thanks, you guys, for taking my call. I've inherited a little bit of money from my father, and I invested some of it into a Vanguard money market. But I've never heard you really talk about it. What do you think about investing in metals, like gold, silver?
Heavy metals, like some of the classic groups
Precious
of the
metals.
80s and 90s.
Right. Yeah, exactly.
He's not funny.
Yeah,
He's
big.
Do
I got
not
some
encourage
CDs.
him.
I got some CDs for you, Mark. I'll
Mark,
get them right
do not
over. No
encourage him. Let me give you a straight answer. Precious metals are an asset. They have tangible value,
Sure.
which makes them better than crypto. But that's all it makes them better than.
They are complete speculation because I can't say general, because
Generally,
when you go to buy and sell them, they're based on whatever the other person thinks they're worth. The applications after that are very few.
yeah, and let me just give you I'll give you the best example in the world, and I've done this multiple times. I've done the math, actually. Went back and checked. Let's say
You did.
2,000 years ago, you lived in Rome, okay? You had an ounce of gold.
Toga.
An ounce of gold back then, you're well-to-do because you have an ounce of gold. An ounce of gold back then would buy you a tailored toga, a nicely tailored. You would look good.
Wait, I want that under my tree this year. I want one of those.
You would look good. Today,
cape, I
an
love it.
ounce of gold will buy you a tailored men's suit.
Right.
It's worth exactly
I
the
see your
same as it
point.
was 2,000 years ago.
It's had a good year, though.
Well, you bring
Had a
up-
very good year.
You bring up the good point that it's all what the buyer is willing to buy it at.
Truly is.
And so I appreciate that information, and I'm going to probably just put more of my money back into my Vanguard account.
Yeah, and
So
and
Wait.
then-
You said it was all in the money
It
It
market.
was all in money market. What you need
Why
to
is it
do?
that?
How much money are we talking about, Mark?
300,000.
Okay, Mark.
I
What
put
is this money? What are you going to do? What do you want this money to do for you?
Well, I'm 65 years old. I want to have it for future retirement. I am still working, but future retirement, and I want it to grow.
But how much of it is of your? If you take the 300 and put that in your whole portfolio, how big a part is the 300,000?
It's about 2/3 of it.
Okay.
The rest
Then that
of it
should
I
be
have the
invested.
401k.
Yeah. See, that money needs to be invested properly based on your risk need and tolerance. For you, it's probably going to be more about risk tolerance. Go to talkingrealmoney.com for me, please. Take the risk quiz there.
will.
Take that risk quiz. That's going to tell you
Okay.
about how much you should have in stocks and about how much in bonds. Then at Vanguard, when you get that number, put the stock amount in VT, put the bond amount in BND.
Okay.
Okay?
Okay, I'll do so. I might give you guys a call to give me a hand with it.
Of course. We're always around.
You know,
You can even call Tom at the office. He'll help you.
Exactly, because I'll start quoting some of those Iron Maiden songs or Black Sabbath or Metallica.
There you
I have
go.
them all right there for you. They're ready to go.
And that's the only heavy metal investment worth making.
Exactly.
Okay, well, thanks for steering me in the right direction.
Mark, you're very welcome. Thanks for listening to the program. And we're going to take a break because we have to. You hear the music that says break is coming. So we're going to just break away for a minute, but we'll try not to break your heart.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
that note, too, by the way, we will be here in person the next 2 Saturdays. Those other slackers who take time off for the holidays, humbug. Get to
Speak
work.
for yourself.
We'll be here. You won't be here?
I'll be here.
Okay.
What else do I have to do?
Waiting for an announcement.
I'm still waiting for my Vision Pro, so what else am I going to do?
You may be doing something else, but you'll be here.
Let's see. That's the 21st. I'll be here.
Yeah.
And then again on the 28th?
The 28th.
I have to be here?
Yeah.
Okay.
You don't have to. Do anything you like.
Do that. There will not be podcasts, though, on the 24th or the 25th.
What?
There will
I suppose
not.
you'd be wanting the entire day off with pay?
And coals, Mr. Scrooge. Please.
Please.
Another candle, sir?
I just went and saw that. It was wonderful. The whole staff just loved it. Really great.
I can't watch it because I always want to be up there.
Because you know the whole thing. You've been Scrooge. You've done the deal. I asked the staff, by the way, which character they thought was most like me. Guess who they said?
Scrooge.
No.
Oh, Mr. Fenwick.
Nope. Fezziwig.
Fezziwig.
I was hoping for Fezziwig. No, Tiny Tim. No idea where that came from.
Tim.
God bless us, everyone.
Nowhere near.
I don't know.
Yeah.
But
really, they said that?
That's
they didn't
what
say
they
you were
said.
Bob Cratchit?
No. I was hoping for Fezziwig. But
the butcher?
Yeah, I don't remember him.
The little boy on the street, the young lad?
Yeah.
You know
Bright
that
young boy, genius
goose?
little boy. Yeah, the largest.
It's a goose in one version and it's a turkey in another.
Turkey in another. Anyway.
Yeah,
All right.
anyway.
Well, you want to see us in person?
No, you don't.
Live? Well, maybe.
We're old now.
I know, but
we're
it's
not
still
as cute
fun.
as we used to be.
I know. It's still fun, and you can see a lot of other great people and learn a whole bunch about your retirement. And it's coming up sooner than you think. February 8th, 2025, Retire Meet.
Is it coming up that quickly? I better get busy on my presentation. Because I'm trying to come up with something totally new.
Which will be great. There's going to be a lot of new stuff there. We've got Kanoa Ostrom to talk about estate planning. We've got Joe Saul-Sehy to talk about the stuff they talk about at Stacking Benjamins. It's going to be a great day. And here's the best part. Right now, still barely early bird tickets are available, but you got to get them now.
Yeah, by the way, just for those of you listening to the podcast, those expire. You won't even be able to get them. No.
I know.
Yeah. Only the people listening to the live show. It's still the 15th.
But you got to get them, and you got to get them now. It includes breakfast and lunch, pretty inexpensive, at the Maidenbauer Center, Saturday, February 8th. We've done this 10 years, and every year sold it out.
Tom at John Howie's afterward.
Only if we have a really good year will I buy dinner for John Howie. The steak the size of, Anyway, come and see us. It's fun. Maine. We've sold it out every year, no joke. This was Don's idea. It was a horrible idea, but it worked out. So show us how it continued to work out. I know, but anyway,
I came up with the name Talking Real Money.
That's true. Retire Meet, that was yours.
Retire Meet.
Yeah.
I came up with the name Vestory.
You did.
Yeah.
I'm
out of ideas now.
Those things. So go to retiremeet.com. You can sign up right there, and soon tickets will be sold out. So you really do want to get them now if you can. So
it is. All kidding aside, it's a really fun event. It's really educational.
Don, we use this little cave.
I hate the fact, though, that when some of my favorite speakers are speaking, I end up doing the show live from the Maidenbauer, and I don't get to hear them. Which I'll do again, and Tom plays.
They're up on the web. Last year's entire program is
I know,
up.
but it's not the same as
No, it's not the same. And see Paul Merriman in his 82nd year, so he'll be joining us too. So
we hope.
Yeah.
Wow. I didn't know he was
committed.
that old.
Retiremeet.com. Love to see you February 8th.
If you want to find other stuff about us, then you go to talkingrealmoney.com, talkingrealmoney.com.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor. Please see Apella Wealth's ADV Part 2A on our website for information regarding Apella's fees and services. Apella Capital, LLC, DBA Apella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Apella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.